All right, welcome in, everybody, to another deep dive.
Absolutely.
Today, we're looking at Gold IRAs.
Gold IRAs, yeah.
Specifically, their tax advantages for your retirement planning.
Right.
We're going to be focusing on an article called Gold IRA Tax Benefits, Advantages, and Strategies by Doug Young.
Sounds good.
Our mission today is to give you the rundown of the tax benefits so you can understand how this type of account could impact your retirement planning.
That's right. I think of this deep dive as like a shortcut to understanding the tax side of Gold IRAs. We're not advocating for or against them, but we do want to break down Doug Young's insights and lay out the tax-related landscape. So if you've been wondering about the tax perks of holding physical precious metals in your retirement savings, well, stick with us.
Awesome. Let's unpack this, starting at the very beginning.
Okay.
What exactly are a Gold IRA? Doug Young explains that it's a specific type of individual retirement account, just like the IRAs that you're probably already familiar with.
Right.
But it allows you to invest in physical gold and other precious metals. Right. And the idea here is to add diversification to your retirement portfolio.
Exactly.
And as we're talking about today, specific tax treatments.
Yeah, I think what's fascinating is this combination of a well-established retirement savings structure, the IRA, with a tangible asset like gold, It's a different approach to solely investing in stocks or bonds within an IRA. This unique combination naturally comes with its own set of rules and, importantly for us, its own tax implications.
So let's get straight to what's probably top of mind for everybody listening, those primary tax benefits. Doug Young's article highlights two main ones. The first is tax-deferred growth. Now, what does that practically mean when we talk about a Gold IRA?
Tax-deferred growth, in simple terms, just means that any increase in the value of your investments within the Gold IRA, for example, if the price of your gold holdings goes up, you don't owe any taxes on that increase. In the year it happens, the tax bill only comes due when you eventually withdraw the money during your retirement. Think of it as the government giving your investments room to grow without taking a cut each year.
The article gives a really clear illustration of why this is significant. Imagine your Gold IRA grows by $5,000 in a year. With tax-deferred growth, you don't pay taxes on that $5,000 until you start taking distributions later. That's huge because that $5,000 can stay in your account and potentially generate even more growth. Rather than a portion of it going to taxes.
Doug Young states, the tax-deferred growth of a Gold IRA allows your investments to compound more effectively, potentially leading to a larger nest egg for retirement.
Exactly. That power of compounding is amplified when you're not losing a portion of your gains to taxes annually. Those untaxed gains can then work to generate further returns. Over the long haul, this can have a substantial impact on the total amount you have saved for retirement. It's like having a snowball rolling downhill, gathering more snow. And in this case, that snow isn't being chipped away by taxes along the way.
I like that analogy. The second major tax benefit Doug Young points out is the potential for tax-deductible contributions. Now, this one has a few more layers to it, doesn't it?
It does,
It's not something that everyone automatically qualifies for.
That's a really important distinction. The article clarifies that if you contribute to a traditional Gold IRA,
those contributions might be tax-deductible.
Okay.
This means that the amount you put into the account could potentially lower your taxable income for the year you make the contribution. It's like getting a little bit of tax relief now for saving for your future.
And they provide another helpful example here.
Okay.
If you contribute $6,000 to your traditional Gold IRA, you might be able to deduct that $6,000 from your taxable income. That's a direct reduction in the amount of income the government taxes that year, which can lead to owing less in taxes overall, all while you're saving for retirement.
However, and this is crucial, this deductibility isn't guaranteed for everyone. Doug Young rightly emphasizes that it depends on several factors. Most notably, your income level,
Okay.
And whether you are also covered by a retirement plan at work,
right,
such as a 401k, because these individual circumstances vary so much.
Yeah.
The article strongly advises you to consult with a qualified tax advisor to get a clear understanding of how this applies to your specific financial situation.
So personalized advice is always the best route.
Absolutely.
When it comes to taxes,
yes.
Let's talk about how you can potentially maximize the tax efficiency of a Gold IRA.
Right.
The article touches on contribution rules and limits.
Uh-huh.
What do you need to keep in mind here?
The IRS sets annual limits on how much you can contribute to IRAs.
Right.
And this includes Gold IRAs for 2025.
Yeah.
According to Doug Young's article,
yeah,
the contribution limit is $7,000 per year.
Okay.
If you're age 50 or older, there's a catch-up provision that allows you to contribute an additional $1,000, bringing your limit to $8,000.
Got it.
It's important to be aware of these numbers
Yeah.
as you plan your contributions.
And it's also vital to remember, as the article points out, that these limits aren't per IRA.
Right.
They apply to the total amount you contribute across all of your IRAs in a given year.
Exactly.
So if you have a traditional IRA that holds stocks and a separate Gold IRA, the combined contributions to both of those accounts can't exceed these annual limits.
Exactly. Staying within these contribution limits is key to fully benefiting from the tax advantages and avoiding any potential penalties for contributing too much.
Okay.
The article highlights that making consistent contributions up to these limits is a smart way to maximize those tax perks over time.
Okay, so you're putting money in with potential tax benefits.
Right.
What about when it comes time to take money out in retirement?
Yeah.
How can you strategize those withdrawals to potentially minimize the tax impact?
This is where careful planning can really make a difference. The article reminds us that withdrawals from a traditional Gold IRA in retirement are taxed as ordinary income. Just like withdrawals from a traditional 401k or other traditional IRA.
Okay.
So the goal here is to manage those withdrawals in a way that keeps your overall tax burden as low as possible.
Doug Young mentions a few strategies.
Okay.
One is to spread out your withdrawals over several years.
Right.
Why would that be a beneficial approach?
By spreading your withdrawals over multiple years, you're less likely to push your taxable income into a higher tax bracket in any single year.
Right.
If you take out a large lump sum, that could elevate your taxable income significantly, potentially subjecting a larger portion of your withdrawal to a higher tax rate.
Okay.
Smaller, more regular withdrawals can help you stay within a lower tax bracket.
Okay.
Ultimately meaning you pay less in taxes overall.
Another point the article brings up is understanding and planning for
required minimum distributions.
Yes.
Or RMDs.
Right.
What are those?
RMDs are essentially mandatory withdrawals that the IRS requires you to start taking from most retirement accounts, including traditional Gold IRAs.
Right.
Once you reach a certain age, currently that age is 73. Each year after that, you'll need to withdraw a certain percentage of your account balance.
Right.
Planning for these RMDs is important
Okay.
because those withdrawals will be taxed as ordinary income.
Got it.
It's not optional.
Yeah.
So it's something you need to factor into your retirement income planning.
So knowing that these RMDs are on the horizon, the article suggests another withdrawal strategy, trying to keep your withdrawals below the income threshold for a higher tax bracket.
Exactly.
It sounds like it's all about being aware of those income levels as you plan your distributions in retirement.
Let's focus on specific scenarios where these tax advantages can be particularly valuable.
Sure.
The article highlights high-income earners as one such group.
Right.
How can a Gold IRA be especially beneficial for them from a tax perspective?
As we discussed earlier, the potential for tax-deductible contributions to a traditional Gold IRA can be a significant benefit if you're a high-income earner.
Right.
For someone in a higher tax bracket, being able to deduct a contribution of, say, $6,000 can result in more substantial tax savings compared to someone in a lower tax bracket. Doug Young illustrates this with an example of someone earning $150,000. Reducing their taxable income to $144,000 can lead to a meaningful reduction in their tax liability.
Right.
And over many years,
yeah,
those saved tax dollars can really accumulate.
it's almost like you're getting an extra benefit on top of saving for retirement.
Exactly.
Simply by reducing your current tax bill.
Yes.
The article also revisits RMDs in the context of tax advantages.
Okay.
Or perhaps more accurately, managing the potential tax burden they create.
Yes, because RMDs are mandatory and are taxed as ordinary income. Planning for them is crucial.
Right.
The article reiterates the strategy of spreading out those withdrawals to potentially avoid higher tax brackets.
Right.
But it also brings up another interesting possibility to consider converting your traditional Gold IRA to a Roth IRA.
Now, we touched on Roth IRAs earlier in the context of when taxes are paid.
Right.
Can you remind our listener how that conversion might play a role in tax planning with the Gold IRA?
Certainly when you convert a traditional IRA, including a Gold IRA, to a Roth IRA, you do have to pay income taxes on the amount that's converted in that tax year. However, the big potential advantage of a Roth IRA is that qualified withdrawals in retirement are entirely tax-free. And there are no required minimum distributions during the original owner's lifetime.
Right.
So while there's an upfront tax cost to the conversion, it could lead to significant tax savings down the road. Especially if you anticipate being in a higher tax bracket in retirement.
Right.
Or if you want to avoid those mandatory RMDs altogether.
Right.
It's a trade-off between paying taxes now versus potentially paying no taxes on withdrawals later.
That's definitely something to weigh carefully as part of your long-term tax strategy.
Absolutely.
Now, let's shift our focus a bit and talk about the actual rules and regulations surrounding Gold IRAs, particularly from the IRS perspective.
Right.
What are some key things you need to be aware of to stay compliant?
The IRS has very specific rules about the types of precious metals that are eligible to be held in a Gold IRA for gold itself. Doug Young's article points out that it must have a minimum fineness of 0.995, which indicates a very high level of purity.
Got it.
And it's not just gold. Silver, platinum, and palladium are also permitted. But each has its own specific purity requirements that must be met. So you can't just deposit any gold bullion or coins you might have.
So it's important to know that not all precious metals qualify.
Right.
There are specific quality standards that need to be met to comply with IRS regulations.
Exactly.
What about where this gold is actually stored? Can you just keep it at home?
This is another critical aspect to understand. The article emphasizes that the precious metals in a Gold IRA must be held by a licensed custodian. This custodian is a financial institution that specializes in managing these types of accounts and ensuring they comply with IRS rules. Furthermore, the physical metals themselves must be stored in an IRS-approved depository. These depositories have high security measures in place to safeguard the assets and maintain the tax advantage status of the account. So no, you can't store the gold in a safe deposit box or at your house.
Got it.
It needs to be in this secure, regulated environment.
That makes sense. It needs to be a secure and officially recognized location to maintain that tax advantage status.
Exactly.
We've already discussed contribution limits. Are there any other key rules or potential penalties you should be aware of regarding Gold IRAs?
Yes. Doug Young's article reminds us of the 2025 contribution limits of $7,000 or $8,000 if you're age 50 or older. And it's crucial not to exceed these limits to avoid potential penalties from the IRS. Additionally, the article mentions the 10% penalty for early withdrawals. That is, withdrawals taken before you reach age 59 and a half. In addition to the regular income taxes you'd owe on the withdrawn amount. However, there are some specific exceptions to this penalty, such as for significant medical expenses or disability. But generally speaking, it's best to view a Gold IRA as a long-term retirement savings vehicle. And avoid taking withdrawals before the designated age to avoid these extra costs.
So it's really intended as a long-term savings tool. And early access comes with potential financial drawbacks. Now, the article briefly touches on the tax implications of holding gold in an IRA compared to owning physical gold directly.
Right.
What's the main difference you should be aware of from a tax standpoint?
The primary tax difference goes back to that concept of tax-deferred growth we discussed at the beginning.
Okay.
Within a gold IRA, as we covered, your investment gains can accumulate without being subject to immediate taxation.
Right.
You only pay taxes when you take distributions in retirement. If you own physical gold outright, any profit you make when you sell it could be subject to capital gains taxes in the year of the sale.
Okay.
Furthermore, a gold IRA provides the added layer of security and professional management through a custodian and an approved depository, which you wouldn't necessarily have if you were holding physical gold directly.
That's a good point to consider. It's not just about the potential tax benefits, but also about the practicalities and security measures that come with a gold IRA.
Exactly.
Now, towards the end of Doug Young's article, there's a frequently asked questions section.
Okay.
Let's quickly highlight some of the key takeaways from that.
Absolutely.
The FAQ section reinforces the main tax benefits.
Right.
That your investments grow tax-deferred, and that contributions to a traditional gold IRA might be tax-deductible.
Correct.
It also reminds you of the 2025 contribution limits.
Right.
That $7,000 or $8,000, depending on your age.
Right.
And the importance of staying within those limits to maintain the tax advantages.
Exactly.
And in terms of minimizing withdrawal taxes in retirement, what were the key points from the FAQ?
The FAQ reiterates the strategies we talked about earlier, spreading out your withdrawals over several years to potentially stay in a lower tax bracket and being mindful of those annual income levels that determine different tax brackets. It's about thoughtful planning when you start taking those distributions.
Finally, the FAQ addresses those required minimum distributions, or RMDs.
Right.
What's the crucial information to remember there?
The FAQ confirms that RMDs for traditional gold IRAs begin at age 73.
Okay.
And importantly, these withdrawals are taxed as ordinary income.
Right.
This reinforces the need to plan ahead to manage the tax implications of these mandatory distributions.
Okay, so we've really explored the tax benefits, rules, and strategies outlined in Doug Young's article on gold IRAs.
Right.
It seems there are some potentially significant advantages, especially with that tax-deferred growth and the possibility of tax-deductible contribution.
Exactly.
However, it's also very clear that there are important regulations and guidelines you need to understand.
Yes.
From contribution limits to withdrawal strategies.
Right.
And the specific IRS requirements for the precious metals themselves and their storage.
Precisely. It's not a simple decision that applies to everyone.
Right.
And a thorough understanding of these nuances is essential.
Right.
While the potential tax benefits might be appealing, it's vital to do your own research. Carefully assess your individual financial situation.
Right.
And as we've said, consider consulting with a tax professional to determine if a gold IRA truly aligns with your overall retirement plan and financial goals.
So just to summarize, we've learned that a gold IRA offers the potential for your investments in physical precious metals to grow without immediate tax consequences.
Right.
And for some, those contributions might even provide tax relief in the present.
Right.
But it's crucial that you pay close attention to how much you contribute, how and when you plan to take withdrawals, and the specific rules the IRS has established for these specialized retirement accounts.
What's really interesting to think about is how an asset as old as gold can become a part of a modern tax-advantaged retirement savings strategy.
Right.
It underscores the importance of not just understanding what you're investing in, but also the entire tax framework surrounding those investments.
Well, that brings our deep dive into gold IRA tax benefits to a close.
Absolutely.
It's been really informative to dissect Doug Young's article and highlight the key considerations. And it leaves us with a final thought to ponder. Consider how a solid understanding of these tax advantages could be a powerful tool in your efforts to build a more resilient and tax-efficient retirement portfolio.
Right.
And perhaps ask yourself, what further exploration into the specifics of custodians and the types of eligible precious metals might reveal for your own individual circumstances.
Right.
Thanks for joining us on The Deep Dive.
Thanks for having me.
See ya.
Take care.
Bye.